candlestick charts. Green candlesticks are bullish because price appreciated and went upwards for the time period. Red candlesticks are bearish because price depreciated and went downwards for the time period. This rectangle area is known as the candlestick body or the real body. These lines that stick out above and below the candlestick body are known as the wicks or shadows or tails. For green candlesticks, the opening price is at the bottom of the candlestick body, and then the close price is at the top of the candlestick body. For red candlesticks, the opening price is at the top of the candlestick body, and the closing price is at the bottom of the candlestick body. The wick ends at the top represent the highest price point of the time period. The wick ends at the bottom represent the lowest price point for the time period. Now let's go through this right on the charts. This here is your time frame. Right now it shows 4H, which means every candlestick you see on screen represents 4 hours of time. This here to the right is the price of the asset at each level. So for example, this green candle here, green opens below and closes above, meaning at the start of that 4 hours of time, it opens at this price here to the right and closes at this price here to the right. For this red candle here, red opens above and closes below, meaning at the start of that 4 hours of time, it opens at this price here to the right and closes at this price here to the right. Let's now show you how to use the risk reward tool. This long wick candle at a recent support level with 2 reversal points presented a long trade setup. You decide to enter long on this bullish momentum confirmation candle, meaning your entry point would be on the candle close here. To figure out your risk reward for this trade, on the left here, where it says forecasting and measurement tools, click long position. Then click on screen where you decide to enter the trade. Your entry here is this price here to the right. Your stop loss here is this price here to the right. Your profit target here is this price here to the right. Your risk reward is set to a default of 1 to 1. Let's say you risk $10 on this trade. When price hits your profit target here, you gain $10. If price were to go in the opposite direction and hit your stop loss, you would lose the $10 you initially invested. You risk 1 to either gain 1 or to lose 1. Now, let's say you want to set a risk reward of 1 for 2. When price hits your profit target here, you would gain $20, which is double your $10 initial investment. If price were to go in the opposite direction and hit your stop loss, you would lose the $10 you initially invested. You risk 1 to either gain 2 or to lose 1. Next, you need to follow economic events and news releases, as these create market volatility. To track economic events, click on the calendar here. And you'll see a list of all the economic events for today. Click this button here so that it filters your calendar to only show high impact events. This here is the time of the economic event releases. This here is the country and currency of the economic event. This here is what kind of economic event it is. This here is what was forecasted. And this here is what the actual released number was. So they either met expectations, which is neutral, beat expectations, which is a positive for the underlying currency, or they missed expectations, which is a negative for the underlying currency. Now, here is a list of the big economic event releases we look at, which heavily move the markets. FOMC meetings, which involves interest rate announcements for the US economy and gives insight into the state of the US economy and shapes monetary policy. This affects the dollar-crossed pairs. Non-farm payrolls. This measures the number of people employed in the United States, minus certain groups, such as farm workers. This gives insight into the current economic situation and occurs on the first Friday of every month. CPI inflation, which is the consumer price index and measures changes in the prices of goods and services in the United States and reflects the purchasing power of consumers. Higher CPI means higher inflation and results in less purchasing power and less spending by consumers, while lower CPI means lower inflation and results in more purchasing power and more spending by consumers. Fed chair speeches, which is speeches by the Federal Reserve Chair and gives insight into the central bank sentiment into things like interest rate decisions, as well as future monetary policy. European Central Bank, or ECB, meetings, which gives insights into the European economy as a whole and provides things like interest rates, similar to FOMC. This has an effect on euro-crossed pairs. PCE inflation, which is the personal consumption expenditures inflation, and is what the Federal Reserve prefers to use for gauging inflation. Retail sales is data that gives insight into the spending patterns of consumers and helps gauge economic growth. Gross domestic product and GDP growth rates, which measures the total value of goods and services within an economy and gives insight into the health of an economy and its performance. Manufacturing Purchasing Managers Index, or PMI, which gauges the manufacturing sector and its economic activity through showing an expansion of production or contraction of production. Chinese data, meaning any economic data out of China, as they have a large effect on the world economy at large due to their massive role within it all. Economic data releases can create volatility and large swings of price, which means potential larger profits, but also potential larger losses.